Joining us right now, first on CNBC, is Medline CEO Jim Boyle. Good morning to you.
Good morning.
Congratulations. This has been quite a road for you to get to this point. Why go public now? What's the thinking in terms of where you came from and where you are right now?
And as you know, we've been a private company for 58 years, with 58 years of consecutive growth. We just feel like this is the right time for us to kind of expand our voice. Historically, we've done very little advertising and very little marketing, and this gives us a way to amplify our voice and actually expand really the receptivity of who we are. We are the largest company you've never heard of, and we happen to be everywhere, which is a pretty interesting thing.
How much of this is, though, about an exit, if you will, for the private equity folks who've been backing this company for at least the past couple of years?
Part of it is that, right? Private equity invests in business to create a return on invested capital. However, I mean, this has been a journey for 58 years for us to prepare for tomorrow. And so it's a blend of both, right? It allows them to create an exit and allows us to create the next step in the journey.
For the investor class that's looking at this and saying, should I be buying in now? Where do they see the valuation? Who do you think are your comps, if you will?
You know, we're
companies that, from a valuation perspective, they should
I don't know that I have an N of one, a comp. I consider Medline an N of one. My aspiration is to be the Costco of healthcare. And what I mean by that is, if you think about Costco, they have a membership model that people pay to be a member of. Medline has a prime vendor model that both the vendor community and our customers pay to be a member of. They have the Kirkland brand that drives savings and value for their membership and accretive margins for Costco. We have the Medline brand that does the exact same thing. They have an extremely loyal customer base. We have a 99% retention rate. And when you think about the supply chain in and of itself, Costco has a pretty robust, resilient supply chain, and we have over 335,000 products with 29 million square feet in the U.S. that we serve customers from.
Can I ask you a question? We just had Mike Johnson on the broadcast talking about healthcare costs in America. What are the margins like at your company?
The margins at our company are built around making sure we can continue to invest in the business to serve our customers. And we have, listen, we sell things that cost pennies. We don't sell things that cost thousands of dollars. So the margin profile is managed in a way that delivers best-in-class value.
But if we can go look in the documents.
Yes, it's 13% EBITDA margin.
So my question to you is, given all of the pressures on the healthcare complex, do you think that those margins long-term can be maintained, can be expanded, get pushed?
Well, the way I look at it is we are the value player in the marketplace. We are best in class from a cost perspective and a price perspective. So I think they can be maintained. The reality is with what's happening with tariffs, cuts in Medicaid, Medicare, I mean, we have to continue to drive down costs to deliver value for our customers.
Hey, Jim, one of the questions has been the amount of debt that the company has, because with private equity, obviously there was some debt that went into it. I think as of the end of September, you had a net debt of about $15 billion and a net debt to EBITDA ratio of 4.5. No healthcare companies in the S&P 500 have a net debt to EBITDA ratio greater than 3.8. Where will you be post IPO, and how quickly can you pay down that debt?
Yeah, we're raising $5 billion in primary. $4 billion will be used to buy down debt to get us to 3.25.
Okay.
With the goal to get sub 3 over time, which we can get to pretty quickly with free cash flow generation.
Okay.
Where do you see this whole healthcare debate going, and also just the strength of the consumer in this moment right now as it relates to either your own products or what you're seeing?
Listen, healthcare is going through a crisis of complexity, right? You have cuts in reimbursement, Medicare, Medicaid. The Affordable Care Act is going through some interesting kind of dynamics right now. You have shifting sites of care. The total hips, total knees, open hearts are all leaving the four walls of the hospital. They're going to the surgery center space. You have a challenge from a labor management perspective. I mean, it is a challenging space. And the way we look at it is we have to make sure we're delivering the right product to the right place at the right time at the best delivered value for our customers to ultimately give caregivers what they need to serve patients. And we're in the boat with our customers. Our customers are struggling, and our job is to deliver solutions and value that yield better outcomes.